I just want to point out that there has been some miscommunication because I had heard last night that I had 4.5 hours. The one thing that Matt had not mentioned about my biography is I have studied at the Fidel Castro School of Public Speaking. Relax. Do I do anything if I close this? Okay, good. It's generational. I don't touch these things unless I have to. In a short period of time, and I really could probably speak for 4.5 hours, but I'll play by the rules on the wall there. What I'd like to do is try to rethink the whole question about what institutional investors do with their money. We all know that they give away their money in some form or another: colleges, universities, foundations, pension funds. That's the purpose of their being, in part. Matt mentioned that I don't use the word mission-related investing anymore, and I think I was probably the initiator, but it doesn't make any difference. What I want to do is talk about investing, and at the risk of it sounding like a new adjective, investing with relation to your purpose, not to your mission. Now, if you think about it, the purpose of a foundation, for example, is the public benefit. That's in the law. It's very nicely put in England and Wales Charity Commission. They simply state that the purpose of philanthropy is the public benefit. Now, the importance of that, to my mind, is that it gets over the set idea of mission. If I'm an arts and culture funder, what's my mission to invest with? Goldman Sachs has a very good art collection, but it doesn't necessarily mean that you want to invest with Goldman Sachs. It may be a variety of reasons, and I can talk about that too. I'm going to their annual meeting, which is always a great show in 2 weeks. Excuse me. Investing with purpose is about... Sure, no, not at all. Yeah. Pardon? Oh. Well, oh, okay. Sorry about that. So let's forget our missions for the moment and talk about... Oh. Does this come out of my time? Okay. And I'm going to go over a number of things sort of quickly because I want to get into a conversation with you now and breaks and during the rest of the meeting. Investing for purpose also meets a fiduciary duty. Now, the tendency, if you go to your lawyer and say, I would like to work around this issue, and the response is, and you ask, can I do it? The answer is no. If you ask the question, how can I do it? The answer is a little easier, but often still tends toward the no side. There is a movement now among some lawyers, and I will send some papers on this to Matt, and you can circulate them to you if you like. Reclaiming fiduciary duty. Duties of care and prudence are the ones that tend to be emphasized and fit with this issue of maximization. But the issue is now the reclaiming of loyalty and impartiality that suggests that both there is a loyalty to your beneficiaries, whether they be grant makers, or grantees, pension funds, students if colleges and universities and the like, and impartiality reflects the interests of long term. You know, most foundations, the Ford Foundation has been, I think, around for, or Carnegie, it's been around for 100 years and expects to be around another 100 years. Whether that's a good thing or a bad thing is another conversation, but they are long-term investors, and this becomes terribly important. So the issue of meeting fiduciary duties fits very well with the concept of your purpose. Now, where do you start? One thing that's been found in a lot of the research on public pension funds is that there is no time for discussion set aside in finance committees for anything that is not necessary at a given time. And conversations about how you use your portfolio, your assets, just don't seem to come up, or they don't get there. A friend of mine is on the, was on the Public Pension Fund New York City, 13 years. He said he'd get his board book, which was 250 pages long, on Exxon and Chevron both. They say, well, we have a social obligation, and it's always fascinating to hear Exxon and Chevron talk about social obligations, because they are what you think they are in conversation. We have an obligation to provide the same oil and gas or fuels to the middle classes of China and India that we had here in the United States. Well, it's hard to argue with that, but the fact is they won't speak about if we hit the 2% within the next 20 years, let's say. What does that mean for us as share owners? Connecticut has a particular interest in this because Exxon is the largest holding, and they've been active share owners for years, and that's partially the definition of insanity, doing the same thing over and over again and expecting a different result. But it's an interesting process, and I'm looking forward to reading Steve Cole's new book, The Private Empire, which talks about Exxon in this way. So in some respects, the first issue is to encompass your investment beliefs as part of an investment policy. And many of us don't do that in foundations. We have an investment policy that says we'll have so much in equities and so much in fixed and so much in alternatives. We don't have that preface that really good consultants like Towers Watson out of the UK, that's one of the world, that says start with what are your beliefs about the nature of the finance and economics world that you're investing in. And the new investment belief that we hold dear at Reynolds and did at Needmore and did at Noyes, the three foundations I've been involved directly in, is that there are these emerging macroeconomic trends like water, climate, and related issues, workers' rights, human rights, that are seen and talked about as societal issues. OECD, to mention them again, if you're interested and you have a tolerance for not the very good news, a month ago put out a state of the environment, the health of the environment. It's a 220-page report, which you don't have to go through, but the introduction is some 30 pages. It's only on the social and trends and issues, but as an investor, it is impossible to read it without seeing that these things are financial, not just societal issues, in the sense that they're going to affect our investments. They are, in fact, investments. Example, Coca-Cola lost its license to operate in the Gujarat state of India year and a half ago because there were terrible droughts, a whole sort of thing, and what do they use? Water as a base. License to operate is pretty important for a company like Coke that says, well, you know Coke better than I do, I suspect, but that they operate in all but 3 countries in the world. They've just had a problem in Nigeria, I think, also, but on the water issue. So to get their license back, they basically were suffering from a risk. They did things that got the license back, and then they realized that it was also an opportunity. And they did it throughout every franchise that they have anywhere in the world. Cost them a little money, but it protected their reputation, protected their right to be in a place. That's the sort of forward thinking that companies do, or the best of companies do. Now, and as a part of the equity questions, I use the term share owner rather than shareholder. I'd say any of you who have stock in a company is an owner, and it's an important distinction. Think of yourself as a renter as opposed to an owner of an apartment. You know, renters, you park on the lawn sometimes and things like that. Owners have a different perspective on these things, if not only because of resale price at some point. In the UK, there is now a stewardship council that is talking about the obligations of owners. vis-a-vis the companies they own. There, at a minimum, you should be voting your proxies or telling your managers to vote their proxies in ways that you think are correct. And that's an interesting process within a foundation because it helps you to bring together some of the interests and concerns of all of the people around the table. There are lots of models of these things, and I could provide them through Matt if you'd like to see it. But it's important to do this. And then at some point, you can become more active in the sense that you can co-file a resolution, which means you just sign on with somebody else who's taken a lead, like the Reynolds Foundation has done with Exxon and Chevron. We're also working with Pfizer and Accenture on questions of Citizens United and political lobbying and political contributions. And I can talk about, if you want, those things. Let me move on to the because of time, move on to the non-equity, non-fixed income side. We've all heard about impact investing. It's quite a, oh, that looks nice. By God. I prefer that. At any rate, impact investing has come upon us thanks to the tens and hundreds of million dollars of the Rockefeller Foundation's generosity. A footnote, but an interesting one, that with all the money that they have spent, there's no evidence that the Rockefeller Foundation has done any impact investing from its asset base. They have done a couple program-related investments, but not that. There was an